Welcome to Think Smart with TMFG. I'm Mike Connon. This is Carlo Cansino, Senior Financial Advisor with CI Assante Wealth Management. So, Carlo, we have a lot of clients coming in and asking questions about mortgage renewals and should I pay off my mortgage or should I go and invest the money, or what should I do? What type of advice are we giving people?
Yeah, no, you're right. You know, as people know, we work with a lot of clients and are fortunate enough to work with family members as well. And we see a lot of gifting happening between the top generation down to the kids. And that's one of the questions that comes up when, you know, there's an amount of money given, whether there's a mortgage, do you pay it off?
I got a lump sum.
Yeah, I got a lump sum of money. What do I do with this? Am I putting it into the market or investing it? And that's a great question. But, you know, I don't think it's a stock answer that you can provide with every client.
Yeah, it depends on a lot of different situations. So let's talk about some of the let's talk about the advantage of putting it down toward your debt. Let's say you get a lump sum of money. What are the advantages in having to go toward debt?
Yeah, of course. I mean, I think we know that when you pay down debt, whatever the interest rate is, you're getting a guaranteed return of that interest rate. According to Bank of Canada, the rates are at higher levels than they were at the previous decade lows. And so if you are paying down your debt, mortgage rates are typically high, so you're getting that guaranteed rate of return.
Yeah, we forget we were living in a decade of 2% mortgage rates, right? And that was that made for It's funny, you look at these decisions, in hindsight, it'd be easy. If you had the crystal ball, you knew what was going to happen in the future, this would be easy. Mm-hmm. And for the last decade, yeah, obviously it made more sense to invest than pay down your mortgage at 2% because markets have been very strong and interest rates have been very low. But we're not necessarily in that environment going forward either. And what we looked at is, it was reading some of the stats in here, and right now in Canada, Canadians have some of the highest rates of debt around, right? And debt can be disastrous because I always say that, you know, when you look at people in life, I've never seen anyone with financial problems with no debt.
Correct. Yes.
The key to financial problems is always debt. So there is something to be said for getting that debt lowered over your lifetime. And when you don't owe anyone money, you're in a much better position.
Yeah, there's that sense of freedom that you have where if things happen that are out of your control and you have a debt or there's an obligation to pay somebody back, you're always going to be in that position where that obligation exists and money has to go out. Whereas if you don't have that debt, you can control your expenses to try to accommodate those shocks that happen in your lives.
And it almost seems like a given, but this has sort of disappeared. Like back when I used to do financial planning many years ago, it was almost a given that when someone retired, they didn't have debt.
Right.
It was just, but nowadays we're looking at people with plans and the debt falls into their retirement range.
Right.
Which is a very scary thought when you're retirement and you don't have income coming in to actually still have debt payments to do. You know, I would say the minimum that anyone should do is they should take their retirement date if you have it and find a way to have that debt paid out by the time you go into retirement, because that's a big hill to get over by the time you don't have income and revenue coming in from employment income. It's nice to have that debt payments gone. And then you can just basically what you have coming in, you can spend to live on, right?
No, absolutely. And I think about those clients that are retiring with debt that don't necessarily have a defined benefit plan. Now they're relying on their portfolio to provide income, and portfolio rates of return aren't necessarily guaranteed. But what is a certainty is that debt has to get paid off. Yeah. So now the income that's coming in isn't necessarily guaranteed, or that rate of return isn't guaranteed, but that debt still has to get paid back.
Well, debt, let's think of what debt is. Debt is paying for the future something you're enjoying now.
Correct. Yep.
Right? That's essentially what you're doing. That's why we take mortgages and we do this stuff. Mm-hmm. We don't wait to buy a house until we're 45 or 50 years old and we can afford it. We'd rather live in that house and enjoy it along the way, and we're going to borrow money to achieve that. When you think of it from a retirement scenario, that doesn't make sense anymore.
No.
Right? So you go and you look at that idea of borrowing money so you can enjoy something now and pay for it in the future. When you're in retirement, that doesn't match at all with the retirement scenario. So, I mean, one thing is always look at getting that debt paid off by retirement.
Absolutely. Yep. On top of that, I think, you know, if you're paying down debt, there not only is the financial benefits to getting that guaranteed rate of return of the interest rate, but there are also, you know, emotional benefits to paying down debt.
Yep.
And I think when you get that debt paid off, I've often heard, actually it's my wife's sister, a number of years ago, they paid off their mortgage and it was an event. They had a mortgage burning party. They literally take that piece of paper and burn the mortgage once it's paid off. There's that feeling of losing the stress of having that debt over your shoulders.
Yeah. It's funny, I had a client the other day, and I remember going to those mortgage. When I was kids, I remember that my friends' parents would be burning mortgages and all that.
Yeah.
And it's funny, they went and they finished paying off the mortgage, and the bank was going to charge them a whole bunch of money just to discharge the mortgage. Yeah. It seemed the oddest thing because they've already paid off the mortgage. They have the money. How can you charge someone $500 just to discharge the mortgage? It used to be nicer when it was a piece of paper. You just have your piece of paper and burn it, right? There was no $500. You'd put it in the fireplace and enjoy it. But now the banks want money for that as usual.
So. Oh, yeah. And that's definitely a way that the banks make their quarterly billions. And we're not going to get into that. But yeah, that's just an additional fee that, it should be a joyous occasion where you're paying off that mortgage, but the banks still find a way to get additional revenue.
Also, the problem with excessive debt is the situation you end up is if you're in a situation where you do need to borrow money or do anything like that, and you already have a lot of debt in there, the ratios don't work out very well for the bank. So if you need a line of credit or you want to buy a car or finance something like that, if you have a lot of debt built up, that goes against the ability for you to do that.
No, for sure. Now, we've talked about a couple of benefits of paying down debt first. What are some of the downsides, if there are any, to paying down debt?
Well, again, as you go do that, liquidity disappears.
Yeah.
Right. So as you're paying down debt, you're taking money that's available to you and moving it toward debt, which you might have a line of credit up with your mortgage where it does continue to give you that availability. But most simple mortgages, as you pay it down, you don't have the ability to get that money back.
Right.
So all of a sudden you go and, like we're talking with cars, all of a sudden you go and pay down a bunch of debt. Your transmission goes on your car. It's going to be $4,000 or $5,000. You can't say to the mortgage company, I want my $4,000 or $5,000 back.
Exactly.
It's not going to work like that.
Yeah. So what's the other side of the coin? You have that money, you can put it down on debt, or you can invest it. So let's talk about the benefits of investing that lump sum.
Investing is great when markets are doing well.
Yeah.
So that's one thing. I mean, the one thing you have to remember is when you compare investing to paying interest, the problem with debt in Canada is it's not tax deductible. If it's on your house, it's not a tax deductible debt. So if you're paying a 5% mortgage, you're probably going to have to make about 8% on the investment side to be the equivalent after tax of your 5% mortgage payments. When you do pay your mortgage down, that's 100%. A nice part about mortgage payments too, it's guaranteed. So if you pay your mortgage down from, let's say, $500,000 to $400,000, you've guaranteed you're going to be paying that much less a year in interest. So that's guaranteed. When you go on the investment side of things, it's not guaranteed, right? If you want to get over that 5%, you're going to have to go outside of buying just GICs. You're going to have to be in the marketplace, which adds some risk to the whole scenario. Not that it doesn't work out. As we said, the last decade, it's worked out very well. You could have went in the last decade and not paid off your mortgage, invested all the money, the difference in the markets, and you would have done a lot better than just paying your 2% interest rates on the mortgage along the line. So it can work out very well. But again, the past does not necessarily indicate the future.
Yeah, exactly. And we've seen that over the last 3 years. The markets have been incredibly good. But again, if we're at that point in time in 2022 and we've got this lump sum and, we have a mortgage perhaps at 5%, where's that money better off? Paying down the mortgage, you're getting that guaranteed rate. But, we couldn't foresee in the future that 2023, 2024, and 2025 would have been as strong.
I guess there's a combination of the two, right, that you look at. And if you go to make that, like what I was talking about before is the taxation. So we'll go outside of invest in the open account. There's other accounts you have. Let's say tax-free savings accounts. Tax-free savings accounts are, because they have equal tax treatment to the market, it's a one-on-one. Like if you're paying a 5% mortgage, all you need is above 5% of your tax-free savings account. Over time, and you're in a better financial position. So that's a pretty simple one. RSPs can put you in a better position even without the returns because you're getting that income back. If you pay down your mortgage, it doesn't reduce your income. You're paying the same tax bill. If you put money toward an RSP, you're reducing your tax bill, which is handy, right? So there's a lot of investments that are directly a lot better than just putting toward your mortgage. It gets tricky when you say, okay, I've maximized my tax-free savings account. I've maximized my RSPs. Do I go open account or debt? That gets the more complex question.
Yeah, no, and that's definitely something to consider. I don't think it's as bad as one might think, only because with an open account, depending on the type of investments you have, if they are all equities, a lot of that gain or that rate of return is going to be in deferred gains, which aren't taxable in the year that you're earning them. They're only taxable when you trigger them. What you have to be concerned about is if you're investing in mutual funds, the dividends that are being paid out as a portion of that rate of return, or the interest that's earned, because that's the portion that you're taxed on in the year that you earn it.
And that's why it makes no sense for anyone to do savings accounts or interest-bearing GICs or anything in that type of scenario.
Right.
Because the tax is a killer. It's paid every year.
Right.
And it makes it very difficult. And whenever you look at any type of fixed income returns, they're going to be related to mortgage returns.
Right.
And they're going to be less than the mortgage.
Yes.
So they're generally less than the mortgage, plus they have tax on them. So that's always a horrible investment.
Yep.
But if you get the investments and things work out, it can work out okay. But if you take a hybrid approach and say, okay, I'm going to have some money go to pay off the mortgage to work to get this debt, but I also want some money going to an investment account.
Yep.
And what that does, it gives you that liquidity situation that we talked about. The problem with paying off the mortgage was the lack of liquidity.
Yes, right.
If you take, let's say, $500 a month, you say, okay, $500 is going to go to an open account, $500 extra is going to go to the mortgage. Every year you have $6,000. Next year you have $12,000 plus interest. It might be worth $13,000 or $14,000. After doing that for 5 years, you create a nice little slush fund to yourself just in case anything happened. And when that mortgage comes due, you could make a decision at that time to move that money to reduce that mortgage down. So it gives you a lot of options. So that hybrid option is very good for many households.
Yeah, absolutely. And I think that's why there's no real stock answer to that question. If you've got a lump sum, whether you're paying down the mortgage or you're investing that money, because investment returns aren't guaranteed and you're taking a long-term approach, you will typically get that higher than the mortgage rate return on your investments. So playing the hybrid approach hedges you against, low mortgage rates or high returns. You get the best of both worlds.
So we always like to give people some stats. What do the stats say?
An average Canadian household has about $1.75 versus per dollar of after-tax income. That's a lot of, almost double the amount of debt that these Canadian households have related to their income.
Yeah, so it's a significant issue amongst Canadians.
Yep.
Canadians are using approximately 14.4% of their income to cover required debt payments, a sizable share of your income to debt ratio. So 14.4% of whatever you make is going to go to taxes, is going to go to debt. And you figure you have taxes taken, maybe 30%, another 14% going to debt. You're getting less and less that you have less to spend on your, let's say, on your living expenses and anything you want to do.
Yeah.
And savings too. Savings has to come out of that remainder.
Yeah. And we were in a position 4 or 5 years ago where rates were really low and people were borrowing at really low rates and perhaps overextending themselves to borrow as much as possible, knowing full well that rates weren't necessarily going to stay that low. Now we're starting to see some issues where debt is a little bit more than what their cash flow can handle.
One concerning thing is Canada has been slipping into this area. The U.S. has got better, believe it or not. Household debt has been improving in the U.S., and Canada has continued to gotten worse. When they went through the crisis 2007, 2008 in the U.S., it gave people a real kick to make sure they didn't do that again. Canada, fortunately for us, we didn't get that kick, but unfortunately, 15 years later, people are going the same route where they keep on borrowing money because you got to make sure you're not using your house as an ATM machine.
Right.
The house is a house is really not an investment. A house is where you live.
Right.
There's investment property. Real estate's a great investment, and if you're doing investment property, income producing real estate, that's all great. But always remember, the house is the place in which you live and you raise your family. And if it comes out later to be worth more, that's a bonus. But it's not supposed to be your financial plan.
In summary, what should our listeners consider if they have that question where they get a lump sum and they've got mortgage? What should they be thinking about?
Well, you should look and see what you can do. Number one, if you have a mortgage, look at what can be paid down extra. A lot of times mortgages have 20% extra that can be paid down per year, or you can double up monthly payments, things like that. So you should do whatever you can to lower that duration of the mortgage, so the amortization period, continue to lower that down. If you can start to double up on payments, do that, and take the other half and see about, you can take the other half and see about getting into the marketplace too. Yeah. Give yourself both things working for you, and then either way you got extra money, so you're going to be ahead of the game. You just have to make sure that you're spreading out your risk, essentially.
Yeah, also we've seen strategies where clients are, depending on their tax bracket and how much income they're earning, they're maximizing RSPs or at least putting into RSPs, generating some form of refund. So again, you're getting the hybrid approach where you're investing into your long-term accounts with a refund, potentially putting down onto that mortgage, as Mike was saying.
Again, this is a time where you go and see your advisor because everyone's situation is different and there's going to be different advice for every different situation. And you should talk to your advisor and they'll give you the approach that's right for you.
If you want more insight about what we've been talking about, actually, one of our advisors, Gabriel Zatoli, wrote an article that went live on our website, but the link is in the description in the video. So have a look at that if you'd like more insight.
Well, that brings us to the end of another episode of Think Smart with TMFG. Thank you very much for listening and have a great day.